We want to continue this conversation. The drop that we're seeing today, the broader markets, like Jared was saying, giving up those earlier gains. And we have Gabriela Santos. She's a global market strategist with JP Morgan Asset Management joining us. And Gabriela, it's great to have you back here on the show. What do you make of the action that we've seen recently? We're in the green earlier. We've given up those gains today. And it almost seems like we've been in this holding pattern now for quite some time.
Yeah, good to see you. I do think we've been in this consolidation phase really since early April. That's when we started a new phase in this market cycle. The first one was that recovery in stay-at-home stocks from March to November last year. The second phase was the reopening phase from November to March. And now we're moving beyond the recovery and focusing on the expansion up ahead. And we haven't had a lot of new data on this recently, so it makes sense to see stocks consolidate. Ultimately, for us, I think what we'll start to see over the next few months is for growth to peak and slowly moderate. That's still a constructive backdrop for stocks. It's just that the actual sector selection, company selection becomes a lot more important. And the focus is increasingly on inflation rather than real growth and ways to hedge upside risk to inflation in this new cycle.
And we keep hearing from the Fed. In fact, we're going to hear from them and Brian Chung in just a minute. But got to ask you, what role, if any, would bonds play if you're going to be positioning your portfolio for an inflation risk, which the Fed says they can keep at bay, but a lot of people seem to think they can't?
I think that's a really important question. What role do bonds play at this early phase of this particular expansion? Because when you're concerned about growth scares, core bonds are a really important part of the portfolio. It helps to hedge those growth risks that can cause wobbles in equity markets. But that's not what we're talking about here in this expansion. We're talking much more about inflation risk. And that's actually a danger period for core bonds. Important to really shorten duration and underweight duration within core bonds. The way to hedge inflation is looking at different asset classes. For example, within equities, looking at certain sectors that can actually benefit from higher inflation, like financials, materials, energy, or different asset classes. And here, a lot of focus for us on private markets, especially real assets, like real estate, like infrastructure. There's a big role to play there in that hedge against inflation.
Gabriela, are you at all worried that the Fed isn't taking some of these inflation concerns more serious? I mean, we have heard from some guests who have come on the program saying that they're actually worried about seeing inflation sustained or hang around a little bit longer than what the Fed has been projecting. Are you seeing any reason to believe that?
So for us, our base cases, we're seeing this pop in inflation, which is very much expected and is very much happening here in the short term. And then we slowly see inflation moderate towards 2% as the year comes to a close. But what I think is important for this new expansion is that you have a lot more two-sided risk. So it's not just downside risk to inflation anymore. There's upside risk as well. And that's that big change, especially around fiscal policy, which is very different this cycle than last cycle. So it's just that there is more two-sided risk, and investors want to price that in the form of an inflation premium in fixed income and want to hedge for that in portfolios. In terms of the Fed, I think they're keeping in line with the framework review they had done last year, where they had changed their approach to inflation to be reactive rather than proactive. So they're really maintaining their line here. In terms of the next step that we're watching for the Fed, it's really not interest rates anytime soon, but it's much more they talking about tapering, which we expect to potentially happen over the summer. And that can really be a catalyst for a continued move higher in rates and a steepening of the curve.
When you talk about the cycle, where are we in the cycle? I know it's the Powerball question, but mid-cycle, are we late cycle? Because that's going to determine how a lot of people plan their next moves.
That's a really important question in terms of how should investors be positioned. So for us, in terms of the market cycle, we don't think it's an early cycle playbook anymore. We're moving really rapidly through this market cycle. It took us 6 months to reach all-time highs rather than 5 years. We have all-time tights in investment grade and high yield spreads. So we're pretty far along in terms of the market cycle. We're much closer to mid-cycle, in our opinion. That doesn't mean late cycle. So it's not time to position for late cycle. It's mid-cycle. What that means to us is we still overweight equities versus bonds. It's just the way to express the bullish view becomes a lot more nuanced beneath the surface. So it's inflation hedges or sectors that benefit from inflation. It's looking overseas for regions that are still earlier in the cycle, like Europe and Japan. And it's focusing back on some of those structural growth themes like technology in China as well. So it's a lot more nuanced from here.